I would identify again, speaking with a small cap perspective, the one strongly performing part of our little market that I guess for 2.5 years now has performed exceptionally strongly, and we've all milked great returns. And I think complacency is set in there as the aged care sector, Matthew, where there's 3 listed players. There's Estia, Regis and Japara, to name 3. They've only been around in a listed state for about 2 to 2.5 years. We had prominent and quite aggressive positions in those. Today we have no holdings in those. And there's a couple of things happening there where I think the market will be shaken from its complacency. Not a deep slumber, but certainly some complacency is set in. The first thing is, to Jeff's point on the federal government revisiting budgets and fiscal attitude, at the end of the day, the federal government spends $11 to $12 billion a year on aged care accommodation. They fund 80% of the cost of a bed. We think that the federal government is potentially going to cap that or reduce that level of spend. That's not great news for aged care operators. We think the level of bonding, which has driven the sector, essentially you sell your home, you take a good chunk of the proceeds and pledge it as a bond for a bed in an aged care facility. That's been somewhat in boom conditions, and that has fueled the growth of that sector. We think that the 2-year cycle of that, because the average resident stays 2 to 2.5 years, the average resident is actually pretty close to being at the point where they're going to be leaving. So bonds coming in now are being used to essentially pay people leaving, rather than before that, in the last 2 years, you've seen essentially bonds funding brownfield and greenfield development. I'd also talk about balance sheets on these businesses. 2 of the 3 companies that I mentioned before, in fact, the whole sector came to market net cash, so the balance sheets look robust and vital. Today, 2 of the 3 actually have quite extended balance sheets, and net debt to EBITDA, which is a measure of gearing or leverage that we apply, is around 2 times, which is, it's a little too high for our liking. Mm-hmm. The median house price, we heard some discussion on property prices. If you think property prices have peaked across Australia, then it's important for people coming into these aged care centres to sell their home and then pledge their bond. If property prices are coming down, their ability to fund the bonds are somewhat impaired. Okay. And the final point I'll make, just to drive home the complacency side of thing, is that there's been a lot of corporate activity, a lot of acquisitions of aged care centres by these listed vehicles, and it's in part propelled those share prices higher. I think the prices of some of these aged care properties have become prohibitive, very, very expensive, and it means that every transaction, or a lot of transactions that these companies are planning on making, they may not get that earnings per share accretion. They may not actually be able to grow earnings at the prices they're paying. Okay. So we think there's one sector which the market has fallen in love with, and we've fallen out of love with and have done something about it.